You've probably heard the term delinquency rate thrown around when talking about financial institutions, credit cards, or loans. It sounds complex, maybe even a little intimidating. But what does it actually mean? And more importantly, why should you care about it, especially when it comes to a company like Bread Financial? Imagine a vast ocean of credit, with countless ships representing loans and credit card accounts. A delinquency rate is like the weather report for that ocean. It tells us how many of those ships are currently facing stormy waters, meaning their payments are late. It's a key indicator of financial health, not just for the individual borrower, but for the company issuing the credit and even the broader economy. A high delinquency rate can signal trouble on the horizon, economic downturns, rising unemployment, or simply a less disciplined approach to lending. Conversely, a low rate suggests stability and responsible credit practices. So, when we talk about Bread Financial, a prominent player in the financial services landscape, understanding their delinquency rate offers a crucial glimpse into their operational strength and the quality of their loan portfolio. They are a tech-forward company offering payment, lending, and saving solutions, including private label and co-brand credit cards. Given their focus on consumer credit, particularly private label cards which often cater to a broader range of credit profiles, their delinquency rate becomes an even more interesting metric to track. It reflects not only their customers' ability to repay, but also the effectiveness of Bread Financial's own risk management strategies in navigating various economic conditions. Now, let's dive into the specifics. What is Bread Financial's delinquency rate? As of May 31st, 2025, Bread Financial reported a delinquency rate of 5.7%. This represents an improvement from the 5.9% rate observed a year prior, in May 2024. This downward trend in delinquencies is a positive sign, suggesting improved payment behavior among their cardholders and potentially reflecting the company's efforts in tightening underwriting standards and enhancing their collection processes. It's also worth noting that their net principal losses, another related metric, also decreased to 8% from 8.8% year-over-year. However, it's important to consider context. While 5.7% is an improvement, it's a figure that financial analysts continuously monitor. Factors such as broader macroeconomic conditions, inflation, interest rates, labor market stability, and consumer spending habits all play a significant role in influencing delinquency rates. For example, the company itself noted that temporary freezes on delinquency progression for cardholders in FEMA-identified hurricane impact zones in late 2024 had a positive, albeit temporary, effect on their reported losses at that time. This indicates how external events can impact these figures. Bread Financial has been actively managing its credit risk, implementing tighter underwriting standards, and being cautious about increasing credit lines. These proactive measures aim to mitigate potential risks, especially considering that a portion of their portfolio is skewed towards non-prime borrowers who can be more susceptible to economic headwinds. The company's focus on diversifying its brand partners and growing its co-branded and proprietary card lending could also contribute to a more stable portfolio over time. Ultimately, the delinquency rate is a dynamic figure, a pulse check on the financial health of both the borrowers and the lender. Bread Financial's recent trends suggest a disciplined approach to managing their credit portfolio amidst evolving economic landscapes. With that said, thanks for watching, and until next time.